Welcome back to Algobot, where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host, Algobot, and today we're studying a strategy called Cup Handle Breakout. This expert advisor is a faithful, automated read of one of the most recognizable and teachable chart patterns in all of trading, the classic cup and handle. Over the next few minutes, you'll learn how the strategy maps out the rounded base and the shallow handle, how it times an entry on a decisive breakout in the direction of the trend, and how its tight, structure-based risk controls are designed to keep each trade small. Let's get started. So what does this expert advisor actually do? At its heart, Cup Handle Breakout is an automated pattern recognition strategy. It watches a stretch of recent price action and asks a very specific question. Does this look like a genuine cup and handle? The cup is a rounded base, a smooth, saucer-shaped dip that falls away and then recovers to roughly the same height it left from. The handle is a small, shallow consolidation that hugs just under the rim of that cup, a brief pause before price attempts to push through. The strategy measures the cup across a window of bars, set by the CupBars parameter with a default of 30, and it splits that window into 3 equal thirds, a left side, a middle, and a right side. For a normal, upward cup, the middle third must carve out the lowest point, genuinely saucering in the center rather than just sloping. The two rims, taken from the left and right thirds, must sit at roughly the same height, and the cup has to be deep enough to be meaningful, measured in multiples of the average true range, or ATR. The indicators driving all of this are straightforward. Price geometry defines the pattern itself. An exponential moving average, the EMA, with a default period of 100, provides trend context, because a cup and handle is a continuation pattern. The strategy only takes breaks that agree with the prevailing trend. An ATR, with a default period of 14, scales every threshold and every stop to current volatility, so the logic adapts as market conditions change. This approach may appeal to traders who are drawn to classic, visual chart patterns and who prefer a rules-based, structural style over a purely indicator crossing style. It works on a single primary time frame, chosen at backtest time, and it's designed around one position at a time. As always, this is educational information only, not financial advice, and trading always involves risk, including the risk of loss. Let's walk through the exact logic, step by step. First, the strategy validates the cup. For a long setup, it finds the highest high of the left third and the highest high of the right third. These are the two rims. It finds the lowest low of the middle third. That's the cup bottom. That bottom must sit below both the left and right sides, confirming a true saucer shape. The cup depth is the distance from the average rim down to that bottom, and it must clear the minimum depth ATR threshold, a default of 1.5 ATR, so flat, noisy ranges are rejected. The two rims must also be roughly level, within the rim tolerance, a default of 1 ATR. Next, the handle. Over the handlebars window, a default of 6 bars immediately before the breakout, the strategy checks for a shallow pullback under the rim. That pullback can retrace at most the handle maximum depth fraction of the cup depth, a default of 1/2. It must stay above the cup bottom, and price must not have already closed above the rim. A genuine handle is narrow and shallow, and that is the entire source of the strategy's tight risk. Now the entry. The just closed bar is the breakout bar. To trigger a long, it must close decisively past the rim, beyond the rim plus a small break buffer, a default of 1/10 of an ATR. It must be a bullish body where the close is above the open. It must be the first close beyond the rim, and its close must be above the trend EMA. Only then does the strategy send a buy order. Risk management is where the design really shows. The stop loss is placed structurally, just past the handle low, minus a small stop buffer of 1/4 ATR. Because the handle sits right under the rim, that stop is tight and pattern defined. The take profit is set as a reward to risk multiple of that stop distance, a default of 2-1. If a later bar closes back inside the rim, the break is judged to have failed and the trade is closed immediately. And once price runs 1 ATR in favor, the stop is ratcheted up to the entry price. The short side mirrors all of this using an inverted, rounded top cup. Let's read the MQL5 as if we're sitting in MinDepthAtr. At the top are the inputs. CupBars, defaulting to 30, sets the length of the rounded base. Handlebars, defaulting to 6, sets the length of the handle. Minimum depth ATR and rim tolerance ATR shape how deep and how level the cup must be. Handle maximum depth caps the handle's retrace. Break buffer ATR defines how decisively price must clear the rim. Trend period sets the trend EMA, and reward risk sets the target as a multiple of the stop. Now the long block. The condition named break OK requires three things together. The signal close must be greater than the rim plus the buffer. The close must be greater than the open for a bullish body, and the close must be above the trend EMA. When that combines with a valid cup and a valid handle, the code reads the ask price, sets the stop loss just below the handle low minus a stop buffer of ATR, then computes the take profit as the ask plus the reward risk multiple of that stop distance, and calls trade.buy. The short block is the exact mirror. Break OK there requires the close below the rim minus the buffer, a bearish body where close is below open, and the close below the trend EMA. It reads the bid, places the stop just above the handle high plus the stop buffer, sets the take profit below by the reward risk multiple, and calls trade.sell. Same structure, opposite direction. Let's walk through this illustration candle by candle and see the pattern come to life. We'll take a long trade first, then a short trade, using the strategy's own cup and handle logic. Look at the opening candle on the left. Price is up near a high. This becomes the left rim of our cup. Over the next two candles, price rolls over and slides downward, smooth and steady, not a sharp drop, but a gentle curve. By the third candle, it reaches the deepest point of the base, carving out a rounded bottom. This lowest point, sitting in the middle of the window, is exactly what the strategy is looking for. The cup must genuinely saucer in the center, not simply slope one way. From there, price begins to recover, climbing back up over the next two candles until it returns to the right rim, roughly level with where the cup started on the left. That symmetry between the left and right rims is one of the checks the strategy makes. The gold dashed line marks the rim of the cup at 10.87.9. The level price must ultimately clear. Now watch the handle. Just under that rim, price makes a small, shallow pullback, a single quiet candle drifting back below the line. This is the handle, and notice how tight it is. It doesn't fall far, and it holds well above the cup bottom. That shallowness is deliberate. Because the handle sits right beneath the rim, the invalidation level is only a hair below the entry. Then comes the decisive move. The next candle pushes up with a strong bullish body and closes clearly above the rim, above the gold line, and above the rising blue EMA trend line beneath price. That's the first close beyond the rim, in agreement with the trend, and the buy entry marker fires. The stop would rest just below the handle low, a tight, structural distance. From there, price extends higher into the following candle and reaches the take profit target, set at a reward to risk multiple of 2 to 1 against that small stop. The long trade is complete. Now the market rolls over and gives us the mirror image, an inverted cup, a rounded top. Watch the candles that follow. Price dips to a low that becomes the left rim of this inverted cup, then arches upward through the middle to a peak, the highest point of this base, before curving back down to a right rim that sits roughly level with the left. The gray dashed line marks the breakdown rim at 10.89.4. A shallow handle forms, this time a small rally that drifts back up toward that line without breaking above the peak. Then the decisive candle appears, a strong bearish body that closes clearly below the breakdown rim and below the EMA, which has now curved above price. The sell entry marker fires on that first close beyond the rim. The stop sits just above the handle high, again tight and structural, and price then slides lower into the final candle to reach its take profit target. If, at any point, a candle had closed back inside the rim, the strategy's fail breakout rule would have cut the trade early instead. That's the complete round trip, a long from a normal cup and a short from an inverted one. And that brings us to the end of our look at cup handle breakout. We covered how the strategy identifies a rounded cup and a shallow handle, how it splits the base into thirds to confirm a true saucer shape, and how it enters only on the first decisive close beyond the rim in the direction of the EMA trend. We also saw how its structural stop just past the handle, its reward to risk target, its failed breakout fast exit, and its break-even ratchet all work together to keep each trade tightly defined. Remember, everything here is educational information only, and not financial advice, a recommendation, or a solicitation. Trading involves real risk, and losses do occur. If you found this analysis helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment with the strategy you'd like us to explore next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.